channel, the channel that's obsessed with the art and science of return on investment. Got a very topical video today, which is, of course, the recent quite significant pullback in the stock market. Stock markets almost all broad indices are down double digits this year. And so I'm going to answer questions that I've been getting about why are stocks falling, what's causing that at the moment. And also I have a way in which I'm playing this in my arbitrage portfolio as to how to profit in a falling market. And there's quite a significant profit opportunity in that space. So without further ado, let's get into it. If you haven't already liked and subscribed, I would greatly appreciate you doing that. And I look forward to hearing your comments in the comments section. Disclaimer, of course, nothing that I say here is advice, and I guarantee nothing when it comes to the validity of the information. Okay, guys? So it's just me and my opinion. This is what I'm doing with my money and the money that I look after. Make no guarantees as to whether it's right or whether it's right for you. I'm not a financial advisor and I don't know your situation. You need to seek out the appropriate professional advice and take responsibility for the decisions that you make. Having said that, housekeeping out of the way, here's a new format for the video today, agenda. So this is what we're going to cover. We are going to cover a review of the major indices and their price movements. Won't take very long, and why that is. We're going to talk a lot about the credit markets today, including the Fed funds rate, the rising cost of capital. And that's the big thing that's affecting nominal pricing at the moment for stocks around the world, and what I expect moving forwards in terms of rising input costs and margin squeeze. And so I'm going to talk about the significance of that, where to hide or where to position ourselves, or where I'm positioning myself to protect and potentially profit. And then today I have a how to profit straight equity play, as well as a bonus for the ROI Club members. I've got something that I've put on, a trade that I put on that has a potential 230% profit, or annualized over the year. It would work out to be 798% annualized return, with a 38% probability of ending up in the black or in the profit. So ROI Club members will get access to that. Let's get into it. So let's take a look at the price action year to date. Okay, so this is the S&P 500 index, down 19.25%. If you're copying the eToro portfolio, you will know that we are down a lot less than that. We're down about 15%, with quite a bit of cash on the balance sheet, with good quality businesses that have been paying us dividends. Unfortunately, dividends and currency conversions aren't calculated in the mark-to-market performance on eToro, which I've complained about quite a lot. So I won't continue doing that. But obviously, if you add that back in, we'd be doing a little bit better. In any case, this is the main broad index, 500 largest companies in the US. Most of this weighting, I think it's close to 70% now, is in very, very few companies. And those companies I expect to do very poorly because they have low free cash flow yields. So quite a lot of money is expected to move out of this space into other spaces. If you watch my interview with Scott from Sow and Reap Capital, we discuss certain places where we believe this money flow is going to go. If we take a look at the NASDAQ, it's even more sensitive to interest rate rises and has dropped almost a quarter. Okay, so down 24% on the year. And the Russell 2000 index down almost 20%. Okay, so Russell 2000, very sensitive again, not just to interest rate changes, but to the real economy. Russell 2000 represents smaller cap companies. And so they operate at a smaller scale in quote unquote real businesses or realer businesses. These are more traditional type services that are subject to margin creep when you have an inflationary environment. So the NASDAQ's very sensitive to interest rate rises for different reasons. Those NASDAQ is mainly made up of the tech type companies. And so they are expected to have long-term payoffs. And in a low interest rate environment, these companies do quite well. They have a low cost of capital, but more so the opportunity cost is different between investing in low yield bonds, for instance, where you can take the chance on investing in a revolutionary technology and you can afford to wait to have that pay out. The Russell is more of a smaller cap, traditional goods and services type businesses that make up the index. They are obviously sensitive to interest rate rises, but they are more so sensitive to cost inputs rising, and that will start to diminish their earnings. Okay, so they don't have the same scale at which to operate as some of these larger companies. Okay, this is really important. So what is this? This is the effective Fed funds rate. So the amount of cash charged out by the Federal Reserve at the cash rate. This is, let's say, the snowball at the top of the mountain. This would be the very start, where the price of credit or money or capital around the world, currency, really, it's not true money, is priced at a certain level depending on where you are in terms of its ripple effect. So if you were to drop a stone in the pond, the first ripple effect would be the Fed funds rate. That's the amount that they charge out to other creditors. And obviously these other creditors, when they lend out credit, they have to put a margin on top of the Fed funds rate. So the higher the Fed funds rate goes, the higher these other creditors will have to charge. Okay. Now, interesting. Here we obviously were coming off the back of the pandemic with the Fed. It was basically zero cash costs. So large institutional banks and insurance companies, etc., could get access to free credit, essentially, which is having a long-term ripple effect of all valuations for all risk assets increasing, because you're essentially getting the credit for nothing. Here you've seen not just an increase, but the verticality of that increase, meaning how quickly the pace that has increased has really sent risk assets tumbling in terms of their nominal pricing. So this is something that's very important to watch. What I pointed out in a previous video is the question is, how high can they raise that rate? So if you look today, increasing it by 38%, you might look at it and say, oh, well, 2.33% historically is a very low level cash rate. But the rate of that increase combined in a highly leveraged environment and a highly leveraged economy that we have will be very, very sensitive to the speed of these rate increases. Another thing to look at is that the Fed always uses retrospective data. So their unemployment data and all the other inputs that they measure, they're always backwards looking. So they may raise the rates, and when they come to their meetings, when they decide to raise, hold, or cut rates, they're using retrospective data. So a lot of damage can occur in between their decisions to either raise, maintain, or cut rates, because they're looking in the rearview mirror. So just because we've started to see things really sell off doesn't mean that cannot continue, because these guys are going to be using retrospective data to make their decisions moving forwards. Okay, here would be a second ripple effect. This is a very important one because we're talking about the US 10-year Treasury yield. Why is that so important? As I've spoken about a number of times, it is because a large amount of investors around the world use this as a pricing instrument. They use this as a measure and a guide as to the cost of capital for companies. There's a large argument to say that that's not really accurate, because there aren't many companies that can borrow at the same rate as the US government, right? But when investors are discounting the cash flows on an investment, they're looking at an investment and they're saying, okay, this is the cash that it can produce. This is the discount rate that we might use plus a premium. The higher this goes, the higher the discount rate that they are going to use on their investments. So the higher that the 10-year goes, the less attractive equities become, because you also have this idea of an opportunity cost. Why take the risk in investing in a publicly listed business, for instance, when you can just park your cash in a US Treasury, which is a risk-free rate? Okay, so if you can get 3.5%, why would you invest in equities as of last year and the year before at certain times when you're going to get a 3% or 3.5% free cash flow yield? Doesn't make sense. The environment's changed. You've got a guaranteed yield versus a possible yield with lots and lots of risk. You're not going to do it. The reason why the prices of the Microsofts and Google and whatever else got bid up to such high premiums, where their free cash flow yield was 3.5%, was because at that time, if you go back to the previous chart, the Fed funds rate was so low. Now you should be able to start to put the connections together. As I spoke about in a previous video regarding the US dollar, the US 10-year, and the price of oil, the three main instruments in which we use as pricing guides, the question becomes how high this can go before the US government starts to run into balance of payment issues or their ability to service the debt. So the US government is trillions and trillions and trillions of dollars in debt. The thought in a lot of spaces around the world is that the US might be able to get this to a 4 handle, 4.5 handle before they have to let it kind of slide and let inflation take off. Because once you get to maybe a 5% yield on the Treasury, something like, and this is old, this is from an old research that I've done, so it may not be accurate, full disclaimer, about 20% of the US budget, okay, the tax receipt, will have to go simply to service the debts. If you're looking for a great resource on this, I recommend Luke Groman, Forest for the Trees LLC's research firm, that it breaks down these numbers really, really well. And so the point is, there has to come a time where this rise in the US 10-year will have to dissipate. Okay, here is a good chart that I've made for you to see the relationship between equities and a rising 10-year, okay, to support what I was explaining previously. So down below here, you have the S&P and you have the Russell. Here you've got rising interest rates as measured by the 10-year yield, okay, rising cost of capital, rising opportunity cost for investors. So as the yields rise, you'll notice the prices fall in the equity indexes that I've mentioned. Interesting to note, you'll see the S&P is less sensitive than the Russell, okay? So will be important to note when we come to the opportunity that I have in terms of profiting from a falling market. The rising cost of capital. This is what I like to call an unholy trinity, because when you've got a rising cost of capital, you increase the discount rates commonly used to value an investment. So if that happens, your cash flows into the future become worth less, okay? You're going to pay less of a premium for those same cash flows than you would today because you have a better opportunity cost. So very, very simply, if you look at a US 10-year yield plus whatever equity risk premium investors are willing to pay, commonly around 7%, let's say, that can change and it's completely up to the investor. 10-year yields at 1.5%, where they were last year, okay, plus 7%, you would use an 8.5% discount rate. So if you were valuing the investments like we do on this channel, what discount rate do you use? A lot of investors use this formula. They'll take the risk-free rate plus an equity risk premium that they add on. And in this case, we'll say the 10-year yield from last year plus 7%. Last year, we were discounting at 8.5%. So obviously, you can pay a lot more to get the same amount of return on the expected cash flows. Whereas now, if we come into today's environment where interest rates have risen quite significantly, 3.5% is the current 10-year yield, as we've seen, plus that same equity risk premium, assuming there's been no changes, you have to use a discount rate more like 10.5%. Now that 2% might not sound much, but imagine you're looking at an investment out over many years, that 2% compounds. In this case, it's compounding to the low side, okay? So you have to discount a lot lower valuation for what you're willing to pay if you want to get the same return on the expected cash flows. Another thing is that lower prices investors are willing to pay for earnings, lower multiples for the reasons I just mentioned. So you're not going to pay 30 times earnings, okay, in an environment where you've got rising interest rates because it doesn't make sense. It also increases the cost of growing those earnings. So if you're a company, how do you grow your earnings into the future? Sometimes you might take on equity by a cap raise. You might issue bonds into the bond market. You might take on debt financing. In a rising cost of capital environment, all of those options become more expensive, okay? So your cost of growing those earnings increases significantly, which means you're less likely to grow your earnings. So now you have this situation where investors are paying less for your stock because they're paying less per unit of earnings. And though that unit of earnings is decreasing for the factors that I just mentioned. And the last leg in that unholy trinity is that investors used to paying a certain amount and getting a dividend stream. That real value of the dividend stream has been diminished because instead of that having a real value over a treasury bond, if you're getting a 7% dividend yield and the 10 years giving you 1.5, the spread on that is quite large versus now if you're getting that same 7% yield, assuming the company can deliver the same yield, the spread has been significantly reduced by that 2% rise in the 10-year rate. Okay, so there's a really an unholy trinity, as I like to think of it. So where do we hide? That's what you're asking. If this is going to continue and the Fed's going to continue hiking till they break something, which is one school of thought out there in the market, why don't we just go to cash? Well, the problem is cash is being eaten up and its true value is being destroyed by inflation. So yes, in the short term, it's a very good hedge because it doesn't have it's an option premium that has no expiry date. And the premium that you pay is the inflation amount. Problem is inflation is a long way north of the 10-year yield. Okay, so even if you were to invest in cash or in bonds, you're getting absolutely smashed in terms of inflation. So do we look to bonds? Well, bonds normally need to rise over 2% above the CPI in order to kill inflation. So the Fed's saying they're going to kill inflation by raising rates. As you'll see in a chart in a moment, it's very doubtful as to whether they can do that given the amount of debt in the system. Well, they can do that, but it's not going to be pretty. Now, what you've got to remember is that as yields are rising, the value of the bonds are falling. Okay, so the nominal pricing of that bond is dropping as the yield is rising. Okay, so think of a house worth 100 grand and you're getting 10 grand a year in rent. Let's say that your yield just doubled. Now, there's only two ways that can happen. You can increase the rent to 20 grand a year and maintain the same value, or you can have the 10 grand a year rent, but the price of the house drops in half. Okay, so if you're holding that bond and yields double, it means that the price has dropped in half. Okay, so you may be getting paid more yield, but you just lost half your face value. So bonds, unless you're very sophisticated in ways that you can structure it in very short-term bonds, to me, I just don't think it's a valuable. I don't think it's a valid investment. So I don't own any bonds at all at the moment. Stocks. Now, this depends. General broad equities will drop on higher yields for all the reasons that I've mentioned, and there are opportunity costs elsewhere. However, there are certain pockets, certain sectors of the market that we're going to come to in a moment that do represent good value. So even if their face value drops, their free cash flow yields are such that you can gain a real yield on that investment while you're waiting for things to calm down in terms of nominal pricing. Okay, let's take a look. So here I have the Fed funds rate over the CPI. So if you look at some work done by credit analysts and macro specialists, macro commentators, there is a school of thought, and particularly one guy uses France as a case example where you had to raise the central bank's cash rate 2 percentage points above the rate of inflation. If we were to do that today, or if the Fed were to do that today, that Fed funds rate would have to be, instead of being 2.3%, would have to be more like 10.5%, which means the US 10-year might be around 14 to 15%, which means the mortgage rates for 30 years might be around about 17, 18%. And so as you start to think about that, you can see that, I mean, the economy would just be smashed. It would be Armageddon almost, right? And so they can't do that straight away. And they don't really want to do that straight away, if we're honest with each other, because the government has run up so much debt. In nominal terms, debt is repaid in nominal terms. they want a certain amount of inflation to be able to pay off that debt with cheaper dollars. This is the financial repression idea at work. And it was effective after the Second World War. They ran up all these debts to pay for the war. They had to pay off that debt with inflated softer dollars. So this is why, if you're holding cash, the Fed funds rate, the difference between the Fed funds rate and the inflation rate, and yes, I know you'll probably get a little bit extra depositing at the bank, but it won't make much difference. The spread between these two is what I call the delta of cash value destruction, because you're getting a certain amount of interest on your cash, but inflation is rising higher. So call it 2.5%, 8.5 minus 2.5, you're looking at 6% of real purchasing power loss, okay, a guaranteed loss year on year, assuming this rate stays the same in terms of just holding cash. So that's the opportunity cost of cash. Okay, so an idea that I'm formulating at the moment is to hide where the money is going. And again, refer back to the interview that I did with Scott from Sow and Reap Capital. The money is in bonds, it's in tech, it's in broad indices. And so we want to go where the money is going, not where it is, where it's going to go if we look out 12 to 18 months, okay? As Stanley Druckenmiller would say, your job is to look out 18 months and see what's the most undervalued asset and start to take positions in there, in that sector. So where can we benefit from inflation and falling indices? Not necessarily immediately though, okay? Energy has a negative correlation with the broad indices. And so I've spoken ad nauseum about energy. This is why it's my largest position across the board. A few notes: commodity stocks can pay us while we wait for the big money flows to arrive via dividends and buybacks. So this is the, I guess, the free content I'm giving you guys in terms of where can you hide. If you just want to do straight equity plays, you can have some cash for the optionality. So if prices drop, you're able to use that cash, but you're burning the premium of about 6% purchasing power. Whereas if you look at positioning intelligently in different commodities, that's where the majority of my portfolios are. We're looking at an average of 25% free cash flow yield from these stocks. So even with inflation raging at around 8.5% at the moment, we're still getting a real return of 16.5% of shareholder return. So these companies are making 25% in terms of their yield, okay? Sales minus expenses, minus taxes, everything, 25% on our investment, minus 8.5% inflation. We're still going along at a decent clip at about 16.5% per annum from their earnings or from their free cash flow. Yes, their prices may fluctuate in between, and they will, but that's not what I'm interested in. I'm interested in putting my money, my capital into a sector that will pay me regardless of what happens in regards to nominal pricing in the short to intermediate term. This is what's known as having real interest. So we have real earnings from industries that have inelastic demand at high free cash flow yields. Regardless of what's happening in the broader environment, we're able to get these yields. These yields, I do believe, or these earnings are sustainable because we will either die out as a species or we will need to eat and have energy to produce all these different things that we use, okay? So it's either the end of the world or sustainable inelastic demand that just so happens to be available to me at the moment for 25% nominal free cash flow yields on average. And in some cases, we're doing a lot better. So another chart that I've used, this is from Crescott Capital. And as you can see, this is measuring commodities to equities. All the money is in equities, okay? And so we're looking for a reversion here, even to the mean would be a really, really nice upside in terms of return on investment. So this idea that I have of hiding where the money isn't yet and where it could be in 18 to 24 months time, obviously using this chart as a ratio, it's fairly straightforward to see that the money is in equities and we would expect that to revert into real tangible things that people will continue to need, even in an economic downturn, which is commodities. Another chart that I've brought forward from previous presentation is looking at the free cash flow yields. So just looking at one sector, energy sector, particularly oil and gas, and the free cash flow yields that we have I own a lot of these companies. Some are in the eToro and some are in the private portfolio that I manage. Average free cash flow yield of 25% is very, very good. Okay, even in a high inflation environment of 8.5%, you're getting that real yield, and that yield will be returned to us either in dividends or in buybacks or both. So, how to profit from a falling market? In other words, how to profit from money rotating out of equities into other spaces, okay, falling into indexes. I've just given you one way in terms of positioning. That will be a long only play. It will be you taking advantage of sector outperformance, and it will require patience because it's not going to happen immediately. So there you go. There's your freebie. In terms of other ways to do it, you could short. Okay, so you could sell an index, expecting the index to drop and then buy it back at a lower price. So instead of buying low and selling high, you're selling high and buying low. It's much more sophisticated. It's not for everyone, and not everyone has access to brokerage that allow them to do it. I have shorted in the past. It's a very tactical thing. You can't just put it on and leave it. You have to really manage it. There are some problems with shorting. The first is that you have a negative carry, meaning you have to pay to stay in the trade. You have to borrow stock, sell it, and then you have to pay the person from whom you borrowed that stock. So instead of being paid to wait, you have to pay to wait for a payoff. Technically, there's unlimited loss potential because stocks could go through the roof. Okay, if you buy a stock, if you go long, the stock can go to zero and no further. But if you short a stock, at least in theory, as we saw with GameStop and some other squeezes during last year and the year before, they can really rip, and you can get your face ripped off in either a squeeze or just a bear market rally where shorts have to cover and that bids the price up and you're on the wrong end of the trade. It's also hard for retail to get access to. So if you want a trade, as I said, that has an annualized ROI for the max profit of 798%, which is obviously very good, 38% chance or probability of the trade being profitable, and none of the above hassles. Okay, so there's a defined risk, and it's relatively straightforward to put on. You can join the ROI Club. Okay, so in the ROI Club, which I'm building out, it's freemium regular publication for astute private club of investors with 7-day free trial. So you can subscribe for free and you'll get some content for free. But you can just have the 7-day free trial. And if you don't like it, you can obviously get rid of it. And yes, if you really want to be that person, you can subscribe and then gain access to all the information and then cancel before your payment goes through. But I know that, yeah, I haven't had anyone do that actually. I mean, very, very good. Access to exclusive content. So this is being built out and evolving as we go, but there'll be a monthly analysis where I'll give you a macro scoreboard, an in-depth stock analysis. So I'll say month in review, month in advance. And based on that, I will go through and do a deep dive on a particular asset or stock, giving my valuation and showing what I'm doing, what I'm buying, or what I might be selling. Exclusive interviews with professional investors. So I've got several of them lined up over the next week, for which I'm really, really excited. The first interview was a hit, and I think that I really enjoyed doing it. And so I think that that's going to be extremely valuable for people. You get access to my intelligence nodes. So for all different information and things that I pay, it's well over like it's nearly 10 grand a year, guys. Okay, so you're going to get access to a culmination of all of that in a very neat, simple package. That's my goal with this, is to make it really easy to follow, simple to understand. You get access to my master valuation sheet, which is a sheet where I have my quantitative numbers on a list of stocks. And again, it's the bare basics, very easy to understand, my valuations, and that gets updated by the software. And then I also update some of the mechanical issues every month. You get the ability to ask questions and make requests in the group. So obviously people in the group get priority over my time answering questions. And if there's something in particular that people in the group want to look at, then I prioritize that and then make my way down the list. Cost, it's not very expensive, guys. It's $9.99 a month if you want to pay monthly, and you can cancel that at any time. Or if you pay up annually and you commit to a year's payment, it's like $60, I believe. Okay, so it's $5 a month if you work it out on a monthly basis. So not expensive, stacks of value in there already. Got a good group of people that have already subscribed and enjoy creating content for the group. So if you want access to that, I'm going to leave a link in the description, obviously, and I hope to see you on the other side where we will continue to thrive in this club. Thank you for watching, and I hope to see you in another video shortly. Subscribe to the ROI Club, and I look forward to seeing you then.